Thank you everyone for having invited me to this session. So this session is a storytelling session. Okay, for the sake of those of you who are not familiar with Asia, go down to 2 pages to page 3, where there's a map of Asia. So right now I am from Singapore, and Singapore is right down south where you see the word Indonesia in big text. Singapore is a little dot, no bigger than Manhattan. Maybe slightly bigger, population of 5 million people. It's sandwiched between two countries, Malaysia and Indonesia, and it's in Southeast Asia. Okay, and the Singapore used to belong to, to be one country with Malaysia. And the story of Southeast Asia and why it turned out the way it did was because Singapore, Malaysia was ruled by the British, and so was India and Hong Kong and so on. And Indonesia was ruled by the Dutch during colonial times. And as you can see from my ethnicity, I would come. My forefathers would come from India. And right now I'm not in Singapore. I'm actually in China. And you can see that China is the big yellow country up there in the north, in the map. And Singapore, Malaysia, Southeast Asia used to be where the great civilizations meet. And so if you visited Singapore, 70% of its population is Chinese, and about 10% only is Indian. But and then you got the ethnic Malay people who are originally from that region. And Malaysia is 30% Chinese, which is much smaller concentration, and then 30% Malay people and another 10 to 12% Indian. So the Indians tended to be a small number, but just as vibrant, just as contribute just as importantly to the economy. And just for context, for the rest of my presentation, Hong Kong is like an appendix on the side of China, and then you have Korea and Japan up in the north. So these are the countries that we'll be talking about. When I was invited to speak to this class, which are essentially accounting professionals, the interesting thought that is building in my mind is that relationship between private and public capital. And you've seen this in the US .com bubble of 2000. The market sort of swung back into private capital more than public capital. So the rise of private equity and also venture capital, they grew very, very quickly and very dramatically. And we talk today about valuations, basically, and that sort of dovetailed with the rise of new technologies and new businesses and new industrial models. The entire internet revolution, and the whole question of how do you give valuations, to companies and to public to assets, that sort of evolved over time. So there are funds at play, but what's more interesting about Asia, and you may not see this very much in the US, is the role of the state. And in some countries, the state plays a very heavy role in capital formation, in capital distribution. And in some countries, not very much. And then there is the public market. And maybe there's another dimension which used to be very important in Asia, which is foreign direct investment. And foreign direct investment was very important during the early formative years of the country, of many of the Asian countries. So just as a rule of thumb, World War II ended in 1945, and many of the Asian countries, started clamoring for their own independence between then and about 1960. The Communist Party took over China in 1949. Malaysia, Singapore became countries in 1957, 1965, and the whole multinational corporations phenomenon and foreign direct investment, especially from the US, sort of shaped the capital markets between about 1965 and right into about the year 2000 or so. And today it's declined a lot. We don't see as much capital from the US, but instead we see capital from another country, China, of course. And you'll see that in some of the profiles that I will be drawing out for you. So this relationship between state and private and foreign and public markets is an interesting dimension. And I don't have answers. So how do we discover valuations today? When you open the newspaper and you see yet another startup saying, "Oh, we are valued $10 billion, and and therefore we are a great company," and all that. But actually, they may only have $100 million in their bank account, or maybe they have or less, and they are really suffering. But the newspaper publicity they give themselves is that, "Oh, we are valued at 10 billion. We are unicorns," as they call themselves. So how do you contextualize the reality of that of the valuations, and also, of course, how will the relationship between private and public capital evolve into the future? Okay. Now let's go into page 4 for Singapore. Okay. So I'm going to be running through several of the major countries in the region: Singapore, Hong Kong, China, of course, and then India, as well as Japan and Korea. Okay. Now, of course, this whole dimension of private and public capital exists in every country, but these are the definitive countries of the region. Singapore and Hong Kong are capital markets of the region. They're like the New York of the region. And then you've got the large hinterlands, China, India. And then you have the functional economies, Malaysia, Indonesia, and so on. Everyone talks about China today, but we should also talk a little bit about the other large countries. So 3 countries in Southeast Asia: Indonesia, Philippines, and Vietnam. Vietnam, I think, is about 90 million, but close to 100 million. But these are the large countries. And Indonesia is 260, 270 million people. So when you take out China and Indonesia out of the equation, you're talking about Indonesia, South Africa, Brazil, and put them into context as very important, significant sized countries. I put some numbers together for me to help profile. So the first thing is, of course, the nominal GDP. And the GDP of Singapore is right now $351 billion, which makes it a really small country as an economy. The second is total bank lending. GDP per capita is very interesting. So if we take capital formation from seed capital, mom and pop, and then into startups, and then into Series A, B, C, and then IPOs. I look at numbers like GDP to get a sense of how real and how significant and how impactful is mom and pop capital in a country. Now Singapore's per capita GDP is 61,000. I mean, very very comfortable, right? On paper, it's one of the wealthiest countries, about the same as the US. One of the wealthiest countries around, although we don't feel wealthy and on any one day. But I think that anything above 40,000 per capita GDP and above, the mom and pop contribution to capital formation becomes very interesting. It becomes significant, but not necessarily all that significant. You can see here that bank lending here is, it's 524 billion as opposed to a nominal GDP of 351 billion. So in other words, it's bank lending is a little bit more than 100%. In other words, the country is marginally leveraged. If you look at the largest companies on the stock exchange, lo and behold, the 3 largest companies on the stock exchange in Singapore today are banks. And so when you go to the country, you will realize that it's a very banking-centric country, and they've deliberately made it that way. And you get worried when the banks in your country are the largest listed entities. It means that they are entities that are making the most money in the economy, and it sort of makes the rest of the economy subservient in a way. It used to be that the property companies, the property magnates, were the were the largest listed entities in Singapore. So it's very bank centric. Okay, and then when you look at the total stock size of the stock exchange, it's nothing to shout about. It's about 600 billion in total capital on the stock exchange, which is about the size of the total bank lending in the country. But Singapore has a phenomenon which sort of distinguishes it from many other countries. It's got two very large sovereign wealth funds, Temasek and GIC. And with these numbers, both these players are able to go around Asia and around the world and participate in other economies in order to to generate to be able to meet its commitments and generate profits for the country. Okay, now so Singapore's sovereign wealth funds are huge, larger than the real. I mean, as large as the capital markets in the country, and they are a significant player. Many countries now have sovereign wealth funds. You need to look at how big it is and how significant it is, and also what the mandate is. So in the case of Singapore, none of that money gets invested back in Singapore. In fact, about 50% of that money is invested in China, which is really China heavy. Because, the people who manage the fund think that China has got a lot of upside, and so it's important to be here. But they're also invested in the US, in Europe, in other parts of the world. So the fact that that money is not reinvested in Singapore, the government does set out funds to help small businesses and entrepreneurship, but that comes from the operating budget of the state every year. Okay, now estimated size of venture capital 11 billion, small, right? And in a number of countries, venture capital and private equity are so small that they form associations that sort of joins the two together. In the case of the largest venture capital fund in Singapore, Vertex, the biggest investor in Vertex is Temasek. So you get a very strong state preponderance, in capital formation. I also take a look at the billionaires, the richest people, the Forbes list, if you will, in each country. And here, what I pay attention to is things like this. Number one, what sort of industries dominate in the wealthiest people in the country? So Singapore, actually, the wealthiest people in the country are mostly property developers, and then now the banks. Singapore's only got three local banks. All three dominate, the capital markets, and so they are much bigger than the wealthy individuals. But and also, by the way, they tended to be old ethnic Chinese in property. Okay, but guess what? In the last few years, a few names have creeped up that are not from Singapore. So for those of you who are looking at the list right now, you'll see Lee Si-ting, and then you see Goh Ching Liang, Chang Yong, and you probably can't tell the difference. But Lee Si-ting, Chang Yong, and Forrest Lee, these three names are from China. They are Chinese nationals who have moved to Singapore. Okay. In fact, what's interesting is that Lee Si-ting business is a medical manufacturing company in Shenzhen. Chang Yong is a restaurant owner, a huge restaurant owner. Every city you go to in China, you can't miss this restaurant called Hai Di Lao. And then Forrest Lee, who's a technology platform owner. Okay, now what it says is that the wealthy in Singapore, the profile of the wealthy in Singapore has changed this way. The locals, And by the way, I said to you when I showed you the map of Asia that Singapore, Malaysia are made up of people whose ancestors had come from China or India, right? So so the within Singapore, looking at a list like this, immediately we'll start saying, oh, who's really Singaporean and who's from China. So the China play is very, very important. And the other thing about I look at is the unicorns that are coming to stream. So here you have Grab, Trust, Moglis, and so on. Now, several of these Chinese companies that are relocated in Singapore, and Grab, for example, is a Malaysian Chinese who moved, who actually migrated to Singapore. Migrated means walking across the causeway. These countries are very close to each other, like right next to each other. So so they are actually almost all foreign. Okay. Moglis is actually an Indian company. Trans is retail tech, and so on. So, and Grab is Malaysian. So here you have a country that's dominated by the state, and then with a new wave of preponderance coming from China, and although the per capita GDP is high, the individuals within Singapore themselves are not significant enough players to create scale to become funders of capital to new ventures and to developments in the country. Okay, now let's look at Hong Kong very quickly. So if you look at Hong Kong on all the same matrix, this is the profile that you get, which is Hong Kong, the 5 largest companies on the stock exchange are all from China, right? So there's Tencent, there's Ping An Insurance, all 4 major banks of China are listed in Hong Kong, right? Now, and per capita GDP is not as high as Singapore, right? And so if you are in Hong Kong, you hear a lot about wealthy people, but you will realize that capital formation at the mom and pop level is not as easy as maybe Singapore. Singapore is easier, but it creates, because it doesn't have scale and because the scale provided by the state is much, much higher, they tend not to be significant players. But what Hong Kong has is an incredibly externalized capital market. So if you look at bank lending, it's 1.4 trillion, right? As opposed to a GDP of 347 billion. A lot of that is actually external lending to China and to the rest of the world, because the Hong Kong dollar is pegged to the US dollar. So they don't necessarily lend in Hong Kong dollars. They have parity with US dollars. So it's easier to lend externally. Several countries in Asia restrict lending in domestic currencies outside the economy because they don't want their currency to be exposed. But Hong Kong doesn't have that problem. And then on top of that, Chinese renminbi has become larger than Hong Kong dollar deposits in Hong Kong. So it's effectively an externalized economy. And of course, it's got the largest stock market in Asia, in all of Asia, $6.9 trillion. I mean, China nominally has a larger capital market, stock exchange, but I'll make a point on China when we come to it. Okay. Now, and then when you look at the billionaires, again, there is a combination of local property magnates like Li Ka-shing, and you have the new Chinese platform technology players like Robin Cheng and I think Li Xiaoqi. Su Hang is very interesting because his partner is living in Singapore and he's living in Hong Kong. So they both belong to the same company. They've done something to to divide the running of the company between themselves. One, Su Hang is the chairman, and Yiting is the CEO of Shenzhen Mine Ray. And then there's another property developer, Peter Wu, who is local. So what you see in Asia is that the profile the ultra high net worths is shifting from property towards digital and so on. In fact, Li Ka-shing is 8% owner of Zoom, the device that we're using right now. And that makes him more money than all the property he has in Hong Kong. Now, and of course, the unicorns that are in Hong Kong, they're mostly Chinese. Okay, Klook is a travel platform. Amber is a crypto finance platform. WeLab, whom I know very well, it's like a digital bank. What's interesting is the IPOs that come out. Lala Move, it was valued at 10 billion, but it's right now going into IPO mode, and it only expects to raise 1 billion. So then the question is, what happened to the 9 billion? I mean, why 10 billion as a valuation and then go to market for 1 billion? So here you get a sense that when these players actually go to market, they see a different story. So China may look very nominal in GDP terms, 11,000, but it's the world's largest and fastest creator of billionaires. The number that you see there, 626 billionaires, that was the year before. They had a rise of 200 billionaires. Okay, and if Ant Financial had gone to market as it was supposed to last year, Ant Financial being the finance arm of Alibaba, it would have created, that company alone was going to create 60 billionaires. Okay, upon IPO. I've seen the list for the Ant Financial billionaires. Very, very interesting. That ordinary people become billionaires overnight, in that way. The most important thing to be said about China is that when you see that the total size of the stock exchange is 13.4 trillion, it looks big, but 70% of China's stock market is state-owned in some way or another. Okay, so the China story from this chart is actually multiple times more complex. Firstly, the stock market is not what you think it is. Maybe about 6 trillion is free float capital, and the Communist Party is afraid like mad that if the stock market goes down, their legitimacy is affected because so what they do is they keep a very tight control on free float. So everybody feels happy being wealthy in China, but the backstop is the state. Okay, and when we look at bank lending of 28 trillion, most of it goes to state-owned enterprises, and in that number is a very large percentage, about 20 to 25% of non-performing loans. So the capital formation in China is actually done by the state is actually somewhat not good. But I mean, I wouldn't say it's not good. It's just broken a little bit, and they have no intention to fix it because that would mean, bringing onto the balance sheet a lot of the NPLs that have been created over time, the bad debt has been created over time. However, in the south of China is this huge south and the coastal cities in China. There's been this huge revolution in digital, where a lot of the new players that you find, their first destination for raising capital is the US. So Alibaba is listed in the US, and so is Futu, a stock that I like playing with because it goes up and down every day. It's listed in the US and so on. And second choice is Hong Kong, and then third choice, not so much for raising capital as much as being branded as being external to China and having integrity and corporate governance and so on, is Singapore. Okay, so the Chinese have this preference in terms of raising capital, and that capital then has a knock-on effect on raising capital domestically. There are several things that I can say to you about China. One of it is that capital formation in China is not a one-country profile. Capital formation in Beijing is different from the capital formation in Hangzhou, where Alibaba is located. and then Shenzhen, where Tencent is located, and Shanghai, where some of the other, especially the fund managers, are located. So, and each of them have an ecosystem that's different from each other. So, if you were to break down the billionaires in China, you break them down to where they're located, and there is a kind of a cascading effect in each of these regions where capital gets cascaded down by the dominant companies that are listed there. If you notice, the largest IPO within China itself are state-owned enterprises. Okay, and all the digital companies had to go to Hong Kong and to the US. India, you notice bank lending and the capital market as a percentage of the GDP is actually anemic. And when you go to India, you actually realize this. It's not just anemic, it's more than anemic. Okay, there's not enough capital going around in the country just through the bank lending route alone. And when you go to the country, you realize that all the banks lend to the same 10 top corporations. And when the same 10 top corporations get into trouble, all the banks get into trouble on the same day. So it's the bank lending route is underdeveloped, partially because cost of funds in India is very high. It's about 8%. Cost of funds in China is high, but it's now like 3%. You can borrow renminbi outside of China at a much lower rate than in China. Okay, so cost of capital in the country is high, but India is very, very high, and the Indian rupee is a very weak currency, and so getting rupee funding is very difficult. So a lot of players raise capital through what is called the carry trade. They borrow in Japanese yen and translate that back into Indian rupees and bring it back into the country. The venture capital and the external private equity and venture capital players are much, much bigger and much more significant in funding new players. And if you look at the Indian so-called sovereign wealth fund, the National Investment and Infrastructure Fund, of course, it's tiny. It's 4.5 billion. I mean, for a country of that size, it shouldn't have 4.5 billion. And if you look at the mandate of the fund, it's actually a co-investment fund with other entities, both corporates and foreign sovereign wealth funds. So the Abu Dhabi wealth fund is co-invested with the Indian wealth fund to be invested in India, unlike Singapore, which is not at all invested in the country. And the top banks are also invested in it. So they're sort of struggling to put that fund together, right? And if you look at the billionaires in India, if you look at Mukesh Ambani and maybe let's look at Gautam Adani, they tend to be individuals who get a concession from the state. Okay, in the case of Mukesh Ambani, it's because of his he sort of dominates the petrochemical industry, and in the case of Adani, he has a very strong position in ports and the export zones in India. He runs them. So and the Tata family and so on. So the wealthy in India, unlike Singapore, Hong Kong, where the old wealthy became wealthy because of property. In India, they become wealthy because of concessions or monopolies, if for want of a better word. But of course, then they too start to change their profile. Let's move very quickly. South Korea, very chaebol-centric, and then you like, for example, the largest venture capital fund is Samsung Venture. And then the next five are also other chaebols like Hynix and so on. And the top five wealthiest people in Korea, interestingly, are not property players. There's a drug maker, Seo Jung-jin. There is a platform player, just like Alibaba, Kim Bien-soo, who owns Kakao, or who founded Kakao. And then you also have the chaebol owners like Jay Lee, who's chairman of Samsung, and gaming companies. Gaming companies are, Korea's got a good number of global gaming companies. So like Smilegate and Nexon. The so-called sovereign wealth fund in Korea actually they are basically a fund manager. Their mandate is to find professional fund managers and hand money over to them. Okay, they don't take a stake. They don't create a personality. You don't see the chairman of the fund photograph. Like for example, the Norwegian fund. The chairman is all around the world because the Norwegian fund has decided to take on 1% of all the equity in the world. So they are a significant player. There's personalities involved. There is objective involved and a mission involved. Whereas in Korea, our job is to hand over the fund to professional fund managers, many of whom are foreigners, and then it gets dissipated, so you don't see the sovereign wealth fund in action around the world. Japan does not have as many billionaires as they should, given the size of the GDP. But what you don't see in this slide deck is the role of the debt market in Japan. Japan is one of the largest, if not the largest, world's debt capital market, and is invested essentially by the domestic pension funds. And a lot of the capital requirement of state-owned enterprises in Japan and infrastructure and so on are funded by debt. Okay, in fact, there are probably there are just about as many billionaires in Korea as there are in Japan, which tells you how much more developed Korea is today. In fact, the other feature about the Korean economy is that it is so semiconductor centric. Okay, 2 of the top 3 to 5 listed companies are semiconductor driven, and then the cascading effect on capital formation down the line, a lot of it is to semiconductor type businesses. Japan is sort of floundering. The largest companies on the stock market are all the car manufacturers. So these are the old economy equivalent of the property players in Singapore. Now, Indonesia, is small. It's got an economy of $1 trillion. I'm very proud of Indonesia. It was the country that was torn apart during the 1997 Asian crisis, right? Asian financial crisis. The IMF came in there and said you must sell all your state assets and your banks, and they listened to the IMF. Whereas other countries in Asia, Malaysia, and other countries, they closed off their currency. They closed off the capital markets for a while to let it, rebuild and so on. But Indonesia sold off a lot of its assets. But eventually, over time, it did become a stronger economy. It's got a strong capital markets, domestic capital market. Bank lending is again anemic. There are already 200 banks in Indonesia, and actually, you think that there should be more. But what's happening is that many of these banks are already associated with their parent company, and actually like funding mechanisms for mid-size, mid-sized companies in the country. So some reconstitution needs to happen on that front. It has about 22 billionaires. It's got a number of very good platform ideas. Okay, the unicorns that are coming on are very, very good. So the big question for countries like Singapore or Indonesia is that when you look at the size of the stock exchange, and you see that the unicorns that are being valued at 10 billion in the case of Gojek or Traveloka 3 billion, the first question you ask is, where are they going to exit? Where are they going to do the realization of their so-called valuation? Definitely not in their home market. Many will probably need to go to Hong Kong, and a lot of the venture capital and private equity for Indonesia actually sits in Singapore. Okay, and I put the US in there for context.
That was kind of a very interesting whirlwind tour through all the Asian countries and their capital markets. Just one observation: it seems that U.S. in terms of its, the GDP per capita and then the debt ratio to GDP is very similar to Singapore. They're very close, actually. and I found that kind of interesting. I'm wondering if you're looking to invest in Asia, is there, do you look at it on a country by country basis and decide, this country right now is better or that country is better, or are you looking more industry specific, or is it something else?
Well, it depends on what you want to be invested in and how much, how big. If you're looking to invest in property, then you would look at countries where government policies and bank lending protect, and also, of course, currency, these three things, right? Protect valuation of properties. And there, Singapore would rate very, very high. The government will not allow property prices to drop. At the same time, property prices are affordable. In fact, there are two-step restrictions for foreigners to get in, just to make sure that it doesn't overheat. And then you have Hong Kong, which is super overheated because for the local population, property was sort of engineered by 9 companies that dominate the land prices in Hong Kong. But perhaps it's overvalued and so on. But when you look at the capital market, it's so large that property markets will probably remain the way they are. So property has its own dynamics. So if you invested today in a country like Malaysia, which used to be driven by foreign direct investment, and property prices used to keep going on the upside because of foreign direct investment, that wind has doesn't blow anymore. So property prices stayed, but at the same time you get good value property. You wouldn't do property in India because the rupee, unless you were living in India or you were from India or something like that, and the valuation of the rupee, the currency, doesn't affect you. Then you go up one level and you say invest in factories. Then you would look at the size of your customer pool from the factories. So there was a time when a lot of the factories used to migrate from Singapore because Singapore's labor costs went up into Malaysia. At that time, the factories were doing 30 million Singapore dollars, which is about 22 to 25 million US dollars in total turnover a year. Now, the same factories moved to China, and the smallest of them do $300 million a year. So like 10 times the size of what they used to be in Malaysia. Because the Chinese market is larger and China is a much bigger export market, and talent pool is much more available. So you have more engineers and so on. And Malaysia has a population of now about close to 30 million people, and any province in China has easily 100 million people. So with a few thousand engineers graduating every year. And then you go up to capital markets, the digital revolution and so on. And there you look at where which cascading effect you want to belong to. Whether it's a sovereign wealth fund or or another Alibaba and so on.
As with everything, it's much more complicated, and so someone like me, if I had a big pile of money, I would need someone like you to help me through that process, right?
I had a question. A lot of the things that you talked about during your presentation were the fruitfulness of each company, talking about the GDP per capita were pretty high in all the companies, the unicorns of each country and the billionaires of each country. But like in the United States graphic that you show, it showed that, Jeff Bezos and people like that are earning billions and billions of dollars. But there is a huge poverty community here in the United States. In the other countries that you showed us, other than the United States, which one would you say had the biggest poverty community, and what is the reason for that?
Oh, this is a really sore pain point for the US right now. I follow what's going on in the US. The US poverty phenomenon actually, in my view, started in about the 1990s, the mid 1990s. When Fortune magazine was celebrating companies like GE and Citibank, externalizing its labor costs to India and China, what these companies were doing was they were actually, in a standoff with the labor unions in the US, and telling them that, if you don't keep your labor costs down, we're just moving out. And so that was the start of that, right? And then eventually the capital markets grew very strongly. And in the US today, you can only become, in fact, anywhere in the world, even in Singapore, I make more money from my investments than I do from working. The rich are becoming rich because of capital markets, and the poor are becoming poorer because labor costs are being suppressed as far as possible. Now, what's interesting about Asia, the good news about Asia, is that a lot of Asian countries have lifted large numbers of their population out of poverty in the last 10 years. So China keeps telling the story of 800 million lifted out of poverty. I've seen that with my own eyes. When you talk to a poor person in China, he doesn't talk like a helpless person. He talks, and even in Indonesia, for example, which has 250 million people and used to have a very large poverty level. I mean, people below the poverty belt. A lot of them have been lifted up, and they'll be lifted up not because they've been given money in their hand, but because of a number of factors. Number one, government spends money on infrastructure around. Number two, local societies are sustainable. When I go to a McDonald's in China or buy a bottle of Coke, I wonder how some of these people can afford it. And they can afford it because their so-called disposable income is high, meaning that although their salaries are low, their houses are taken care of. It's either subsidized by state or by family, and there's a network effect of cross-subsidizing. And the government has done a lot to develop the rural parts of China so people don't have to move to the city if they wanted to. Those things. So this rich-poor divide, and Thomas Piketty's book really is about markets. So if you want to see where you will see a real rich-poor divide, look for the markets with a very strong, developed capital markets, and see how many of those people participate in that. So Hong Kong, for example, the reason the young people are going into the streets is because, number one, the property prices of their fathers have gone up so high that they can't afford it anymore. And this is their country or their city. And they're looking at their own assets, and it's beyond their reach. And who's owning them now? Hong Kong capital market is stock exchange, $6.9 trillion. Now, a lot of the participants of that are foreigners in Hong Kong. So you would feel disconnected from your own local community, and that's where you get disenchantment. So you might think that the countries with more poor people like India or Indonesia, have this social divide problem more, but no, it's actually sometimes the richer countries as a result.
In terms of these various, all this data that you have, these, benchmarks and things like that, how do you obtain those? What are the resources for that? Do you do actually research on your own, or your associates that you work with, or is this stuff all readily available?
Yeah, most data is readily available. I run a research company called the Asian Banker. We have offices in Singapore. Our home office is Singapore, and I'm the founder of the company, of the organization. So my staff put the data together. But all the data that I've shown you is public data. Data today for many countries is with macro level data is readily available. The only problem you might have is that some of them might be lagged a date, so a year off or 2 years off, or they might repair it the year after. And especially during COVID, some numbers are skewed a little bit and need to be reconstructed, and so on. So macro data for most Asian countries are readily available. Maybe some really small countries like Nepal or Bhutan or something like that, you might have problems, but generally they are well available. Yeah.
It really makes the point that markets are very complicated things, And there's a lot that goes into these decisions to invest in this industry or in this country, and you know, and the differences between one country and another country. So I think that was highlighted very well, and I think it gave us an appreciation for it. So I appreciate the presentation and the time that you took for us. We have one other question. I'm not particularly familiar myself with this, the central bank digital currency. And what are some of the factors that are pushing for the CBDC creation and the adoption in Asia?
My favorite topic. So central bank digital currencies are a red herring. I think they will die a natural death. This is my personal opinion, and there's almost nobody who agrees, who even starts to see it the way I do. Okay, there has been several experiments in central bank digital currencies before China announced its central bank digital currency, which then got all the other countries, afraid that they're missing out on something. The Uruguay had an experiment, and guess what? The IMF sponsored experiments, they all were deemed to be successful, and then they closed the experiment and they moved on. In other words, none of them took off as a result. Now, China had a peculiar problem. China joined the WTO. Visa, MasterCard wanted to get into China, but what China did was they closed off the market to Visa, MasterCard, and they set up their own entity called China Union Pay. But between 2003 and about 2010, China Union Pay did a bad job. They made payments, not very popular and so on. At the same time, the platforms like Alibaba and Tencent were building their own payment platforms. I don't carry money. All my transactions are on the phone. Absolutely zero need for money. I'm so not kidding. And this was made possible by WeChat and Alipay, creating their platforms and turning that into payment platforms. WeChat Pay started 2011, and about the same time, Alipay went on the mobile device in about that time, 2011. And you need to think about the digital revolution, the platform revolution, how it actually morphed from the desktop version that Facebook and so on were pushing in the US. So 2010, 2011, mobile payments just took off in a big way. And between 2010 and 2016 or so, China didn't regulate them. And so they just grew. And the very regulators who were formulating the regulation to regulate mobile payments were users of mobile payments. You couldn't live without mobile payments in China. So then the government finally got its act together, created the legislation, and there are reasons why it took a country like China took them a long time to build that. And they found themselves in a situation where the digital wallets of Alipay and WeChat became much larger than the payments done by the banking system, and they are a threat to the banking system. So the state then thought, hey, there's this new technology, blockchain centric, which is we can take it over and we can make it digital. And take the digital payments and run it from the state, from the central bank, okay? And that's what central bank digital currency is. Now, central bank digital currency was supposed to be one of two things. It's supposed to be a token. Some of the arguments trying to formulate central bank digital currency is that it's token based as an alternative to cryptocurrency, right? But what it turned out to be was nothing more than a digital wallet run by the state rather than by a Alipay and a WeChat Pay. Okay, and it's a statement of account. It's a balance that you have with the central bank directly because now you can do it digitally. That's it. That's the only implementable version of central bank digital currency today, anywhere in the world. Then comes the question of, does the state want to take on that responsibility? Because now you have all that data from the use of the currency. I know in the US, the pushback against central bank digital currency is that you don't want the state to have the responsibility, but or to have that access to your money flow. But all the countries in the world have the same issue, which is states are not institutionalized to have that much data on individual, to deal with that. So say, for example, you get a corrupt person, and the police wants to track his movements. They go to the central bank and say, show me his central bank digital currency movements. You do that to one person, you do that to 5 people, you do that to 100 people. The role of the central bank starts to break down as a result. Okay, and then of course this whole thing about the fractional deposits, the liquidity of money in the economy. When you have a statement of account, you actually lose the liquidity. The liquidity comes from not knowing where the money is, from the floats that are created, from the transfers that are done, and from the loans and the leverage that is created from that. And the most important thing is this: central bank digital currency never went to become the tokenized replacement of cryptocurrency that some of the central banks wanted it to be. Because they don't have the technology to manage that volume of transactions in a unified structure. They just don't. If you look at each crypto token, Tezos and so on, the amount of talent that is going into crypto tokens to make them interoperable and so on is running much faster than central bank digital currencies. So I think that what will happen is it's going to be a passing fad. And the central bankers that I've spoken to, their big concern is that fiat currency will be taken out of their hands. That's their big concern. And I think it will be taken out of their hands. One other thing about central bank digital currency is that, China, a lot of the publicity given to China is not created by China. It's actually created by people who either think China is bigger than what it is, or they're afraid of China. So, China wants to export its digital yuan. It doesn't have the capacity to do that at all. And the reason is that Chinese renminbi doesn't have interoperability between its current and trading accounts, its capital account and its current account. And it's a closed currency. It's not a traded currency outside of China. How they made it part of the IMF basket of sovereign currencies, that is a charm effect on Christine Lagarde. It's nothing to do with what the renminbi really is. And when you look at all the Chinese businesses that do business outside of China, including those on the Silk Road, on the Belt and Road Initiative, all of them want to be paid in dollars. Okay, and securing foreign exchange is very important to every country in the world. And the most important foreign exchange is, of course, the dollar. Not because America is a great country, but because the dollar is circulating around the world so much, and it's the most deeply liquid currency. So if you wanted to externalize your central bank digital currency, your enemy is the dollar and the deep liquidity of the dollar. So how are you going to replace that? You see, and the US actually runs in exactly the opposite. It's externalized its dollars so much that it doesn't want the money to come back into the US. Okay, so more than 30% of US assets are held by foreigners. More than 70% of the dollar in circulation circulates outside the US. Okay, so it's like the rest of the world has given you capital in exchange for the dollar circulating outside. And there's a law about bringing money back into the US. You can't bring in more than $10,000, for example. So the US is not, it's already externalized its economy, and it's more likely to continue to shape the nature of global currencies because it's externalized and because it's vulnerable than a country that is large and is closed. Do I think that cryptocurrency is here to stay? Yes.
What is the reason for decreasing foreign direct investment from the USA to Singapore and increasing China? You mentioned that early on, that China was becoming much more significant foreign direct investment into Singapore than the US.
We used to think of US as being superior and Europe being superior and all the so-called developing countries. You know, if you read the Financial Times, they say rich countries. And I go to the US, I feel like I'm in a poor country. Sorry to say this, but you know, you feel that, okay? Now, the thing is that what the US does is it recycles the capital of the rest of the world, okay? Every day that it has the confidence of the rest of the world, it becomes an aggregator of capital. You know, it's not necessarily wealthy in its own self. And someone pointed this out to me, which is, if Ghana is where the gold is, why is Ghana not the most richest country in the world? You know, something's wrong. You know, the people have taken the gold out, have paid Ghana nothing, and made the price of gold what it is in the capital market. So that's actually what's going on. Now, I'll give you maybe two reasons. One is that manufacturing has transformed dramatically. The reason the US was a big investor in Asia was because the US large manufacturers were externalizing their manufacturing plants. They wanted to be, number one, closer to their markets, number two, looking for cheaper places to manufacture. So like, for example, the first large investor in Singapore was Hewlett-Packard, $5 billion in 1970 something. Right, and I think it was 1975 probably. And Singapore was so excited that to get $5 billion from Hewlett-Packard in that time. Today, Hewlett-Packard doesn't do manufacturing anymore. It contract manufactures to everybody else. So it's not in a position to spend $5 billion anywhere. And so, you know, the new microchip manufacturers, they look for the cheapest possible places, and Singapore is no longer one of those places, right? So it's a function of externalizing labor costs, where capital comes from, and also being closer to markets. And today, because China is so much wealthier, a lot of the capital comes from China. The Chinese capital is slightly different from the US capital, because the US capital was externalizing US manufacturing out to the rest of the world originally, but then later the rest of the world also created demand. So those manufacturing plants were eventually bought by the local players, like in Singapore, in Indonesia, and so on. And then China started externalizing, but China externalized for other reasons. Number one is excess capital, but it's not really to externalize manufacturing, maybe not to Singapore, but to countries like Vietnam, because cost of production has gone up in China a lot as well. So the short answer is that because there are no more investors coming out from the US. In fact, if you look at the US economy, at the high end, it still dominates. But there is hardly any manufacturing taking place in the US today. In fact, the conversation that's going on in many circles is, oh my goodness, we should not lose our manufacturing capability. You know, not just for the US, but many, many countries. So that's one. Second is the recycling of capital. Maybe there are lots of Singapore investors in US markets, and the Amazons and the iPhones and the Apples of the world, they are now focused on huge markets. So if you look at private equity and venture capital of the largest US players, they are in India and China for sure, and Brazil and South Africa. So they're looking at the large countries because they think that they should get that right, more than in Singapore. So it's become a multifaceted dimension in terms of where capital comes from and why.
Okay. Well, thank you so much.
Please come to Asia, and maybe hopefully the dimensions I've given you give you a sense of what you can expect.
Yeah, I've been to Singapore, Malaysia, Hong Kong, Thailand. I love all of those places. They were fantastic. So yeah, so I would encourage everyone to go there too.
Excellent.
All right. Well, thank you so much for your time.